Before we start today's show, I just wanted to mention our sponsor, Wealthify. Wealthify is regulated by the Financial Conduct Authority and is a multi-award-winning online and app-based investment service founded in 2016 and owned by Aviva. With a simple mission to make investing accessible to everyone, you can invest from as little as £1. Wealthify has a simple yet competitive single flat rate fee and offers a number of investment products, a stocks to shares ISA, a general investment account, a personal pension, and a junior ISA. Within each of those, you can invest in a range of managed portfolios with varying risk profiles and even ethical portfolios. During January, Wealthify is offering new customers a year of no management fees, so it could be a great time to get started. Terms and conditions apply. See wealthify.com/new year for more details. With investing, your capital is at risk and you could get back less than you put in. Now on with the show.
Hello and welcome to episode 351 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leakes. Damien, welcome back and Happy New Year to you.
And Happy New Year to you, Andy, and all our listeners. So you probably can tell I'm excited as usual, to be honest. I'm always excited at the beginning of podcasts, but I am very excited about the start of this new year because we are doing the new challenge that we spoke about on the last podcast, the Christmas Carol, which had some really good reviews, actually. You wrote in and we had some nice reviews of people thanking us for sharing our Ghosts of Christmas Past, Present and Future. But I'm excited about the new year because we're starting our 28-day fitness challenge, essentially. It's a 28-day program where we're helping people sort out their finances, and you're going to hear a bit of a mantra going forward from us of own it, fix it, grow it. And they're really the three key stages of fixing your finances and improving them for the future. And people are at different stages of that journey. So what we're going to be doing is in the next 28 days, and you can follow this on Instagram, and if you are a newsletter subscriber, you will have had a sneak preview of what's coming in the next week or so in Sunday's newsletter. But if you follow the program, the first 2 weeks are going to be about owning it. So that means owning your finances, including the mistakes you've made, so you know where you are. And essentially, you're going to build that black book, which was one of our most popular episodes, actually, the black book of your finances, which details everything that's going on with your money, including your debts, investments, pensions, savings, insurances. So you know where you are, and you then own it by putting it down. And only when you can then own it and quantify it can you start to fix it. And then we'll move on to that in the second half of January. But this program is going to be one that you can do at any point. And the aim is to do little and often. So the tasks that I'm going to give people are going to be quite short each day because I want people to maintain momentum. But if you miss a day, it doesn't matter. You can just take a break and then carry on with the tasks in your own time. But it's better to try and keep some form of momentum. So what I suggest, if you're listening to the podcast and you want to see what this 28-day challenge is all about, I guarantee you that anybody who does it is going to improve their finances from where they are currently. That means even if you're on top of your finances or if you feel that your finances are in a bit of a mess, then follow us on Instagram because that will be probably the best source of finding all the different URLs. And we will obviously put some links in the show notes to this podcast.
Okay, so let's get on to this week's podcast then. And we're going to do a little look back into history. We're going to look at last year's show that we released at exactly the same time of year where you, Damien, looked forward to 2021. And we're going to see what you said and how much of that came true, and if it didn't, why it didn't, but also then looking forward to 2022, and you're going to give your predictions this year. And this is becoming a bit of a tradition for Money to the Masses. We're going to release a show each year looking back at what you said and then seeing what happened and looking forward. So no pressure on this one, Damien.
No pressure. And just to reiterate, this is in relation to investing. So it's a focus on investment markets. So what happened in 2021 and some of the themes to keep an eye on in 2022. I don't have a crystal ball, but I could talk about what the likely themes are and what some other people are suggesting could happen.
So I've picked out a few clips from last year, and Damien, you're hearing these for the only the first time since you recorded it last year.
So I have no idea what Andy's about to play. That's the point. So I'm reacting to these genuinely. So I hope I've at least got something right from last year.
Okay, so let's play out the clips then. Let's start with the first one. And this was about the S&P 500 and your predictions on where it may go.
So looking at this year, I'm going to just throw it out there because people are usually quite interested. If you look at the S&P 500, so that's the US equity market, the main indices or main index, I should say, out there in America, and they are predicting a rally. I've taken the average across a whole range of investment banks and their predictions. They're predicting that the S&P 500 will finish around about 4,100 at the end of 2021. Now, that would mean that we're likely to see about a 12% rally from where we are roughly at the moment. And put that into context, last year, as we moved into 2020, they were predicting a rally of 6.5% on the S&P 500. It turned out, obviously, that they had been slightly pessimistic in that regard, but that was only after the market recovered from that 30% slump when the pandemic hit. So the fact that the S&P finished up higher, they hadn't factored that in, of course, into their prediction. So the point is that 2021, this year, investment banks are predicting is going to be even better than last year.
So Damien, having listened back to that, how did you get on?
Well, they were the predictions of the investment bank, so I didn't actually make a prediction in that, but I was relaying the predictions. But it was unbelievably pessimistic, to be honest with you, because as we make this show, the S&P 500 is sitting at 4,680, so just shy of that 4,700 level. And if you look at the year-to-date performance, then it's about 23 to 24% up. I mean, that's more than double what they were predicting. So it was a positive year. It was even better than 2020, but I don't think anybody probably expected it to be as positive as it has been. But having said that, we obviously focused on the S&P 500 because that's what the investment banks will talk about in America. And these investment banks are based in the US, so they will talk about the S&P 500. And one caveat you've got to chuck in there, no investment bank in the world is going to say markets are going to crash because they make their money out of people investing through them. So they are going to be always slightly positive. And the long-term average, since the S&P 500 has been the 500, it's about 7 to 8% annual return on average. Longer term, if you go back much further, then it's nearer 10%. So we were way more than what the long-term average is. But there were big winners and losers, because if you look globally, then if you go to emerging markets and Asian equities, then they were actually down on the year. They were in negative territory, down sort of 4 to 5%. And most other developed world equity markets were up somewhere between 12 and 15%, which is therefore more in line with those S&P 500 predictions from last year. So the message was 2021 was another year where being invested in US equities was a good thing, and big tech especially. But one thing that this doesn't tell you is that 2021 was a year of rotations, and we saw some whipsawing with the winners and losers changing quite a bit during the year. So we had value and growth stocks at different times outperforming each other, and we had tech stocks initially the laggards in the first quarter, then they've roared to be the eventual winners for the year. So while it looks like it was another year where just investing in big technology stocks in the US was what you should have been doing, that's with the benefit of hindsight. It wasn't that simple throughout the year.
Okay, so let's move on to the next clip then. And you were talking about company valuations and how the vaccine rollout might affect things.
If you think about the valuations of some companies, they are at levels that can seem quite mind-blowing, to be honest. I mean, if you think about Airbnb, its valuation is heading towards almost double what it was before the pandemic. Well, the pandemic pretty much stopped all global travel. So you can see there is a definite euphoria in markets that a company that has been hampered so much by the pandemic has a valuation that's almost twice what it was before the pandemic hit. So, I mean, there are lots of factors as to why that will be. Some of it is the easy money going into markets from central banks, but it shows that the market is very bullish at the moment and is predicting that we're going to have a massive rebound economically. Now, economically, we're not predicted to get anywhere near the levels we had before the pandemic for, well, probably not until 2022. So the market is pricing in a rebound from a relatively low base in the economy around the world. A lot of that is going to be based upon the success rate of the vaccine in terms of people taking it and being able to give it to people, so the take-up rate. Yeah, so that again was quite an interesting clip. because what we had was with the vaccine rollout, then we started to see those rotations I just mentioned really come to the fore. So we started to see cyclical sectors that were the laggards in terms of valuations suddenly rally as economies reopened and economic growth rebounded. And so we started to see in that first quarter those valuations of cyclical companies accelerate while the valuations of growth companies started to fall. And that was partly because people were thinking that interest rates were going to start to rise. But then again, as the year went on, what we saw is that there were concerns about inflation, and there was also concerns that the rate of economic growth, the rebound, would start to slow down. It was unsustainable. And so we started to see a slight leveling off in certain valuations. I mean, if I just give you the S&P 500, the price to earnings valuations now are quite a bit lower than they were this time last year. And that's because a PE ratio is the price divided by earnings. And of course, the forecast for earnings kept improving when we had the economic rebound. Earnings did in fact improve. So the mathematics of that ratio then started to bring down the valuations of stock markets. So even though stock markets have continued to push to new all-time highs, and in fact we've had, I think it's 67 new all-time highs on the S&P 500 this year, technically from a valuation perspective, they are cheaper than a year ago because of the rebound that we've seen in economic growth.
Okay, so let's listen to a clip now where you're talking about equities and bonds and the relationship of those, and also the impact of the dollar on investment markets.
The other themes that are worth talking about that we're going to be seeing a lot of in 2021 is equities versus bonds is definitely going to be one. So in the first part of 2020, bonds did very well, gilts, treasuries, and they protected your portfolios when the global economy was collapsing. Because don't forget, fixed interest bonds do well, especially the high graded bonds, so treasuries and gilts do well when the economy is slumping. But of course, if the economy is going to start aggressively growing again and rebounding, then that is generally bad news for bonds, but good news for equities. So when we had the vaccine come along at the start of November, the rotation trade that we had, we saw equities suddenly do really well. I mean, at one point in the sort of mid-December, we were up about 15% on most indices from the start of November to mid-December. That's a huge rally, but bond markets had generally lagged the equity market. So will we see equity markets outperform bonds? And it's largely going to be down to whether the pandemic comes back and the economy slumps further. Because don't forget, there is still a lot of the pandemic fallout that we've yet to see in terms of job losses, particularly in the UK. One of the other things I think is going to be a major focal point in 2021 is the value of the US dollar. So currency exchange rates. The US dollar seems to underpin nearly everything in investment markets. It's had a huge influence in 2020 in particular, where you get some really strong correlations, both positively and negatively. And going into 2021, there are a lot of people, and when I say people, I'm talking about investment banker analysts, who are predicting that the crash that we've seen in the value of the dollar, because it has absolutely plummeted in the back half of 2020, they're going to see that continue into 2021. And some are anticipating almost a 20% fall. That's a huge number. The point is, whether that number is true or not, the consensus seems to be for the dollar to continue to weaken. And why could that be? That will be if we see more stimulus from, say, the US government, more stimulus from the US Federal Reserve. They will put downward pressure on the US dollar. So if we see the US dollar fall, that will be good for US equities, but it won't be good necessarily for UK investors who hold them because of the currency exchange rate. So just to break that down, for US equities, it will be positive because obviously if you are a US company exporting, then your goods are cheaper. That's good for you. You can make more money. The problem is if you're a UK investor and you hold stocks in a company like that, then the value of your asset, which will be denominated in dollars, will actually be worth less if the value of the dollar falls against the pound. So that clip, Andy, was really interesting. So the first thing I want to latch onto is the bit about the dollar. They couldn't be more wrong. They said the dollar was going to collapse, it was going to fall 20%, but it didn't. And in fact, what we've seen in the early part of 2021 was the dollar, it grew in strength and then weakened slightly, trod water, but then come the summer, exploded higher. And it's now in this bullish trend pattern. And of course, a strong dollar has a lot of impacts for markets around the world. It impacts emerging markets, it impacts commodities, something that I'll talk about a bit later. So markets got that completely wrong. And it wasn't a massive headwind for equity markets as such, because I talked about that equity markets would outperform bond markets, and they did, because what we saw were bond yields spike as well. So bond yields exploded higher. And if you look at the 10-year US Treasury yield, it was below 1% kind of going into 2021, but now it's up around about 1.5% as I make this podcast, but it was as high as 1.7% at one point during the year. And that was because the narrative that the market had created changed, and it all became about the reflation trade. So investing in sectors that would do well if interest rates were starting to rise, cyclical sectors, as I mentioned earlier. So equity markets rotated and they started to rally, and those sectors did well. And we saw rotations back and forth in and out of cyclical sectors as the narrative changed throughout the year. But it meant that markets were bullish on equities. They still felt that central banks would keep the easy money flowing, which they did. So interest rates remained low and QE was still there. And so that just pushed things higher. But on the flip side, when everybody thinking economic growth was going to be very buoyant, that's why bond yields spiked and bonds underperformed. So if you looked at your portfolio, there's a very good chance that the bonds that you held, depending what type they were, may have lost money throughout the year, whereas your equity funds within your portfolio would have been making double-digit returns, more than likely, again, depending on where they are invested. So it was interesting to hear that the part of that was correct, but then the dollar part was completely wrong. And that ended up being quite positive for UK investors because they got a bit of a currency kick in the second half of the year when the pound weakened against the dollar. So it was an interesting clip, just shows that the consensus can be wrong, but it also highlights, more importantly, how markets rewrite narratives. And even though the narrative at the start of the year might predict one thing would be bad for equities or good for equities, then they can very quickly rewrite that narrative to be whatever they want, and it will be positive regardless. So that's why that clip is particularly interesting.
Okay, let's move on to commodities next. What did you have to say last year?
Commodities is another play. Now, most commodities are denominated in dollars, so a weak dollar is positive for them. That means if we see a very weak dollar, we could see things like gold do quite well. We could see oil do well. And commodities have been pretty much, depending on which commodity you pick, I mean, there have been nuances. For example, the last 2 years, gold has been in a bull market. But if you take them as a group and look at a broad index on commodity prices, we've been pretty much in a downward spiral for about a decade. And commodities, you won't hear many people talk about commodities in portfolios because they've been a way to almost lose money because they've been tumbling in value. At the back end of 2020, when we saw the vaccine, we saw the enthusiasm and optimism around the global economy and the future growth in 2021. That therefore meant that people started buying commodities aggressively. And so they are predicting that with the economy expanding globally, particularly in China, there's an increased demand for commodities. Therefore, that will push the price up. Of course, as I mentioned, the dollar is falling, which is always positive for commodities. So there could be the beginnings of something quite interesting in commodities. And there are people talking about maybe the beginning of a new bull market or a super cycle in commodities, because we do see these big cycles that happen periodically in commodities. And like I say, we've been in a bit of a downward cycle as a group for much of the last sort of 5 to 10 years. So are we going to see something where it gets quite exciting and people start buying commodities again? So it was interesting on commodities because commodities has always been one of those sectors that people have been saying will enter a bull market or there'll be some real positive returns. We just haven't seen it. And with the pandemic, commodities crashed because obviously if economic growth falls, then the demand for commodities for manufacturing starts to fall. And what we saw in 2021, it was a great year for commodities. So we saw commodities generally rally. And depending on which commodity you look at, yeah, you could say there were bull markets in them. If you look at the broad indices, they were incredibly positive for the year. Even gold managed to scrape out a positive year. And anybody who has been looking at their energy bills will have seen energy prices going up. And so what we got was that commodities were a very good way of playing inflation in 2021. So as economies opened up, and we still had that loose monetary policy from central banks, it started to push up the price of real assets, and it was reflected in commodities.
Okay, so let's move on to inflation then. What did you have to say this time last year?
Are we about to see inflation come back? Because we haven't seen inflation in recent years, or certainly not seen aggressive inflation and gaining traction. But are we about to see it, particularly if the dollar is weakening? Because that means that the cost of things start to go up for US consumers. But equally, if we see something similar in other parts of the world, in the UK, if we continue to keep interest rates low and produce easy monetary policy by, for example, in the UK from the Bank of England, those will all, in the long run, probably start to cause inflation to go up. It's like that analogy when I talk about changing down the gears. And if you start changing down the gears on the car, the revs go up. And if you go too high, the engine can blow. The rev is the equivalent in that analogy of inflation. And so you would therefore start to move the interest rate or the gears back up again to stop the economy, aka the engine, blowing up. So we could start to see people talk about inflation again. So listen to that one, Andy. I underplayed that. I mean, all we talked about all year was inflation. If you listened to midweek markets, then you would have heard the word inflation. It probably, if you did a sound cloud of almost anything that was done on midweek markets or anything you read in investment newspapers or articles, inflation was the number one topic of 2021. And that was because we saw it come back with a vengeance. And I mean, if we look in the UK and the US, we're hitting decade high inflation rates. In the US, it's like multi-decade. I think it's 40-year, 39-year high, I think is the actual number. And so central banks now, as we move into 2022, are starting to become more hawkish. We saw the Bank of England in the UK raise interest rates in December. We saw the US Federal Reserve speed up the rate at which it was tapering its QE program. So overall, there is a hawkishness to lots of central banks because of this concern over inflation. And what happened, there was an obsession with the word transitory that came from the US Federal Reserve. So what happens when they do their meetings, they release statements of those meetings. They're called minutes. And in those minutes, they are very careful about the language they use, and analysts pore over that language. And the word transitory with regard to inflation entered the language that the US Federal Reserve was using, meaning that it would probably just be a passing fad. And it was driven by supply and demand dynamics caused by the economies opening up again rapidly after the pandemic. But now they've dropped that word transitory. And I think central banks are acknowledging that inflation is a cause for concern now. And there are predictions that it could persist into 2022. So something I'll talk about in a minute. So that is a very good clip. But in hindsight, it's quite funny to hear that we might possibly talk about inflation when that's all we did.
And so let's listen to the last clip where you're focusing on UK smaller companies particularly, and what might happen.
If we see the pound strengthen in 2021, then it will put people off holding overseas assets and global funds. They're more likely to want to hold UK funds because therefore they don't get hurt by the currency moves. And you'll probably have a look and see what happens with UK equities. Will they rally as people find them more attractive, especially if we get some political stability? But in particular, UK smaller companies, will they do well? They had a very good end to 2020 after the vaccine was announced. But will that trend continue into 2021? So it's something to keep an eye on. Again, it's an interesting clip. I mean, the whys and wherefores of why UK smaller companies might be a good place to invest. I mean, Brexit was resolved. I mean, essentially, we left the European Union. The currency element didn't strictly come true because we did see the pound strengthen, but then weaken. And it's kind of where it was at the start of the year. But the point about investing in smaller companies, UK smaller companies have been a core part of my portfolio, my 50k portfolio, that is, on 80/20 Investor for the entire year. And to give you a steer, they are up about 40% year to date. They have gone sideways in the last couple of months, but they are up 40 odd percent. I'm looking at one fund in particular that I think I might mention in some of the other shows that I hold. So that was an incredibly profitable place to be. Whether that will be so going into 2022 will be interesting because normally there's a seasonality. Go back and listen to our winter portfolio podcast that we've done. And there's a seasonality to investing, where UK smaller companies tend to do quite well over the winter months. That's from November through to April. And we're entering that period again. But last year, it was given a real boost by the vaccines. And so that rollout helped the UK economy as it was opening up. And like I say, one of the biggest beneficiaries were UK smaller companies. So it was a very profitable place to invest.
Okay, so that's the review of what was predicted last year heading into 2021. And now, obviously, we're in a position, having been through 2021, where we can now look forward to 2022. And this is what the second part of this podcast is all about. Damien, can you share some insight into what 2022 will hold for investors?
So I don't have a crystal ball. I always caveat that. But to start with, let's go back and mirror what we did last year, where we looked at some of the investment banks' predictions for 2022. And like I say, they always focus on the S&P 500. So if we look at that, then if I take an average of some of the top investment banks, they are predicting that the S&P 500 is going to be just above 4,900 at the end of 2022. So as I mentioned earlier, we're roughly, as I make this, just below 4,700 on the S&P 500. Then that means that the average return is going to be about 7% if what they are predicting comes true. And that is broadly in line with the long-term average for the S&P 500, probably a little bit on the pessimistic side. I mean, the range of predictions are quite wide. There are some banks that think the market's going to fall, and there are one or two that think we're going to be hitting the dizzy heights of 5,300 within the next year. So there's a range of predictions, but the overwhelming theme is one of positivity, although the notes that they throw in alongside these predictions do have words of caution alongside them, which are basically focusing on whether global economic growth can continue at its current pace. So moving on, I'll go through a couple of themes. Inflation is definitely going to be talked about this year. So last year I was a bit more, we might talk about it. We're going to be talking about it at least in the first half of 2022. And that's because there are predictions that say, for example, inflation in the UK is going to get up towards about 6% in the spring. So we'll have to see if that comes to fruition. It means that we're going to be focused on central bank policy as well. So that is going to be another theme going into 2022, whether inflation continues and central banks' responses to that. But there are quite a few investment banks that think that inflation will moderate from the current levels as we head through 2022, but they do think it's going to remain above the historical norms. And now, if you think about in the UK, the target inflation rate is 2%. So they still think it's going to be higher than normal. And therefore, it's going to be an environment where central banks are likely to have to try and tighten monetary policy, which will mean raising interest rates. And therefore, that will be positive for sectors maybe like financials, for example. But almost hand in hand with the inflation theme is going to be COVID. And so Omicron is one of the biggest things that people are talking about at the moment. We may look back in a year's time and almost forget what Omicron was, because if you go back to earlier in the year, it was all about the Delta variant that people have sort of now moved on and are focusing on the Omicron variant. The variants of COVID are going to have a big impact, not only on our lives, but on economic growth. So at the moment, the focus is on possible strengthening of restrictions in the UK and other countries, such as lockdowns. And I mean, we've had lockdowns in Europe already because of Omicron. And so that will start to potentially impact economic growth if they are sustained, a bit like what happened going back to 2020. And should that happen, then that could have an impact on inflation, because if the demand for commodities starts to fall as it did before, then what could happen is that inflation will start to fall, because the demand for products and services will start to fall. And they're all the things that start to make up the official inflation figures. So going into 2022, inflation is going to be important. We're going to be talking about it. But the one thing we've learned at the back end of 2021 is that central banks really are focused on inflation. So even though there was a lot of talk that they may hold off, I'm talking about the Bank of England in particular here, hold off raising interest rates in December because of Omicron, that they didn't, because they were so concerned about inflation. And that seems to be a similar view of the US Federal Reserve. So inflation is going to be the one thing I think central banks are going to be focused on. And therefore it leads on to what will happen with monetary policy. And I'm going to veer straight into another theme that I want to quickly talk about, and that is central bank divergence. And it's something that I've been pondering in recent months. And we have the Bank of England raising interest rates at the end of 2021. The US Federal Reserve is predicted to raise interest rates 3 times in 2022. It hasn't done so yet, but it is tapering its QE program more quickly. But the ECB is suggesting that it won't be raising interest rates at all in 2022. So we could start to see some kind of divergence in central bank policy. So not everybody being hawkish at once. I mean, in Turkey, they're doing their own thing. They're cutting interest rates to the dismay of everybody else, and they're crashing their currency. But that is a very unusual example where somebody seems to be hell-bent on crashing their economy. But I think going into 2022, we may eventually start talking about central banks not all doing the same thing. And there are signs that that's occurring anyway, where other people are raising interest rates. I'm talking about central banks and other central banks that are holding off. And I think that will make a difference to equity markets globally. So you may start to see some more nuance, and we might start to see some easing, because we've seen some easing actually in China at the back end of 2021. Could it be that we start to see a divergence with central bank policy in Asian markets? So that is something I think will be very interesting going forward. There are a few others that I want to quickly talk about, and one of them is the US dollar. And it's funny that you picked out that clip from last year where there was talk of it being a weaker dollar, the dollar would start to fall. We've got to 2022 now, and I think there is starting to be a consensus forming that we're going to get even more strength in the US dollar, at least in the short term. And of course, that could potentially start to cause a headwind even for US equity markets, but it likely will cause a headwind for emerging markets. And we've already seen that at the back end of 2021. So the last quarter, many emerging market indices struggled, and that's because many emerging market companies will have their assets denominated in their local currency, but they may have their liabilities, so their debt, denominated in dollars. And of course, when the dollar strengthens, that dynamic means that their attractiveness falls because their debts theoretically start to grow when you convert them back into their local currencies. And so you also get a movement of money, of capital, away from emerging markets back towards the US as well when the dollar strengthens. So if we do see a continuation of dollar strength, then it could also cause a problem for commodities because they're denominated in dollars. So that typically means that if the dollar strengthens, commodities tend to weaken, particularly gold. So keep an eye on gold going into 2022. So again, the dollar seems to underpin a lot of things, but we're in complete contrast where we were going into 2021. So have a look at the US dollar. One other thing, I was talking about yields earlier on. I do think we might start, and it's a bit of an out there prediction at the moment, to be honest, but I do think we're going to start talking about or hearing about the yield curve again. And the yield curve is where you look at the yield on short-term bonds. So let's take the US Treasury market. So it might be the yield on a 2-year US Treasury versus the yield on the 10-year US Treasury and ones that are 30-year term. And in a growing economy, then the yields on the near term tend to be lower than on the longer term. That means you want a high yield if you're going to lend money to the US government for a longer time. But I think that there'll be a lot of focus on the yield curve in case it inverts again. And that's where you get a high yield short term versus yields long term. That will likely be a reflection of people thinking there's going to be a policy mistake by the US Federal Reserve in this case. So they will be forced to have to cut interest rates because we could end up in a recession. And that recession could be caused by something like COVID, or it could be caused by something else entirely, or just be part of the economic cycle. So as an out there thought, I do wonder if we're going to start hearing about the yield curve changing shape and ultimately maybe even inverting at some point. And if it inverts, then that has always been a reliable indicator of a potential recession. So that's something that's worth listening out for if you hear more and more conversations about the yield curve. I think we're also going to probably be talking a bit more about politics. So there's probably less focus on politics last year because Brexit was finalised. We had the US election the year before, and the focus was more on central banks. I do wonder whether we're going to start to see a bit more political turmoil in 2022. It could be in the UK where we get a change of prime minister. There's also the midterm elections in the US. That's in November, so the back end of next year, which is always something that markets will focus on, whether it causes a shift in power within US politics, but also I think geopolitics. So I think there's very low level attention being given to potential issues with the US and Russia over Ukraine, but also with China and the US, whether there could be any more trade disputes or anything like that. So I think those are things that could start to rear their head in 2022. It's something that hasn't really been on the agenda in 2021, but there's always, they could potentially be the black swan events that we might not be thinking about. And another theme I think we're going to hear a lot more about is the climate crisis and ethical investing. I think we're going to see climate investing becoming much more mainstream, and I think we're going to see new products launched in the market. And I think we might start to see the potential for certain companies to start to benefit from having green credentials, because at the back end of 2021, even Vanguard has launched its own ESG fund. So I think that will be a theme that we'll see running through 2022 even more and probably gain more attention. A couple of other points just before we finish the show is it'll be interesting to see, will we see different sectors start to outperform? I think we could have a year where it becomes more about stock picking. So I think we could have a year where we're going to see divergence in fortunes for certain markets. We saw a little bit geographically that I mentioned in 2021, but I wonder if we're going to see a lot more in terms of sector and company levels where there are going to be a little bit more difficult to generate returns. So there are going to be a year where maybe being a little bit more active could benefit fund managers. And of course, the only thing is that it's been 2 years since we've seen a real major pullback in equity markets. And you don't want to predict that there's going to be one in 2022, but it'll be interesting to see what happens going forward. Equity markets are at all-time highs or near multi-year highs, but that is being matched with people being quite fearful. So if you look at the emotion-driving markets at the moment, it is more fear than greed. So that would be interesting going into 2022 to see if we just see more talk about potential correction in equity markets. And of course, if we do see that, then don't be surprised if central banks then start to make U-turns. So I think U-turns could be another key word for 2022.
Okay, so that's it for this week's podcast. If you want to get in touch with Damien, you can do so in the usual way. It's damien@moneytothemasses.com. Don't forget to check out Instagram. Just search Money to the Masses. You'll find the account there. Follow our 28-day plan where we'll be helping people to own it, fix it and grow it over the coming days. And if you're new to the podcast, then it's worth mentioning that we have a fantastic Facebook group. It's a community group where everyone can get involved. They can talk about the show, post questions and receive help and guidance from like-minded people. So that's facebook.com/groups/Money to the Masses. Damien, that's it. We're done for this week. It's great to be into a new year. I'm charged and excited. And so until next time.
Until next time.